payment should you be looking to buy a house in the short to near term future. Bear in mind, historically speaking, immediately following Fed rate cuts, mortgage rates have shown signs of going up, followed by going down. And what that does for the monthly payment, just what does this do over time? Rates have been coming down. Inventory is rising in the housing market. May make you wonder, with interest rates coming down, what does that mean for affordability and a mortgage payment should you be looking to buy a house in the short to near term future? We're going to dive into this question today. I'm also going to discuss the impacts to your pocket over time, what this means to your net worth, some considerations about future refinance opportunities, and I'm going to drop in some interesting tidbits in real time about the Denver housing market right now. Look, my goal is simply to educate you and make a difference as you look to build your wealth through buying real estate in Denver and or Texas. Today, we're going to clearly break down payment differentials with an example and showing 0.5% and 1% incrementals reduction in rate and what that does for the monthly payment and some things for you to think about if you're looking to buy a home in the short to near term future. For this example, Redfin shows $675,000 is the average price of a single family home in Denver. So we're going to use that equation to build around this idea as we dive in. I'm going to exclude taxes, insurance, and mortgage insurance for the simple fact that at the end of the day, we're talking rate differentials, and the only thing that changes in the payment is principal and interest. So let's dive in. First, as you can see, at 6.25%, the principal and interest would be $39.48. You see a total payment of $44.79, estimating what it might include for taxes and insurance on that property, and mortgage insurance as well, given 5% down. Now, the 0.5% reduction in rate would drop that payment $206 a month. Principal and interest would be $37.42, all things constant, $42.73 for the total payment on that property. Then, if rates went down to 5.25%, what you would see is principal and interest $35.41, all things constant, $4,072, as you can see here, an additional $201 a month in savings, or a total of $407 for that 1% differential in interest rate. Now, a thing that I just learned in modeling something out for our client today was that change of 1% and have a net impact of a total of 10% more affordability, or as you heard, a $400 a month savings that could be plugged back into life to cover other expenses outside of owning the house. So a huge savings with that 1% drop in rates that by my charting has happened in the last 5 months already, leading up to this conversation about the Fed rate cut. Bear in mind, historically speaking, immediately following Fed rate cuts, mortgage rates have shown signs of going up, followed by going down. Check the history on it, but you might find it interesting if you look into this as well. So just what does this do over time? If rates go down 0.5% or full percent, you can see here on that house, $780,000 total interest on the loan with 5% over 30 years. At 5.75, $705,000, so $75,000 savings, or $633,000 when it goes down a full 1%. So that's huge savings for you of $147,000, that 1% swing in interest rate on that house you're buying at 675. Now for an investment impact, there's kind of two ways that my brain would think about this. There's the opportunity savings with the higher versus lower payment. What you could do with that money. What you could do with that money is you could plug it back to the home loan, pay off the house faster. We're going to dive into what that would do for you relating to the savings on the time value of that money. Or you could look at investing that $407, $206, and then $201 into the financial markets. And what would that do for you over time as well? Let's dive in first at 6.25 to 5.75. If you apply that over $200 a month back to the mortgage, you would pay off the house in 316 months and save just under $100,000, about $99,000 in interest on that home. Now, comparatively speaking, if you took that money, and you see here, I've got some historical data from SoFi about 30 years. And I picked 30 years because if I have a mortgage for 30 years, let's look at the S&P for 30 years. Now, bear in mind, from 1993 to 2023, SoFi is saying 9.9% in the S&P. So if I took that $206 a month in savings, didn't apply it to the mortgage, rather just open an account in the S&P and just $206 every month, 9.9%, $300,000 would be my return. You heard that if I applied it to the mortgage, I would actually save about $100,000 in interest. So it could make sense to dump this money back into the financial markets. Of course, if you can get 9.9% for the next 30 years, that is. Now, as we look at this from 6.25 to 5.25, you heard me talk about $407 a month in savings. If you took that money and had the 1% lower rate and dumped it to the house, you would pay off the house in 283 months, so less than 24 years, and save $157,000 in interest. So as my son says, put that up here. If I took that into the markets and if I got that 9.9% return, I would actually, instead of $157,000 in interest savings, I would actually make $428,000 with that compound interest over that period of time, which I picked 23 years because that's roughly how long you'd have this home loan for if you sent the extra money back to the principal. Now at this time, as rates are coming down, one of the important things that I'm talking to my clients about is to pay or not to pay, meaning points. Well, as you can see, if in 5 months rates have come down 1%, if you pay points right now to achieve a permanently lower rate, points being that historically 1% in fee on the loan amount to save, roughly 0.25% in interest rate, and those are loose numbers. Would and should you do that if rates continue to come down? I could tell you 42 months. That's on average. If you pay 1% in fee to save roughly 0.25% in interest rate, it takes about 42 months of cash on cash investment, meaning if I bring extra money to closing, I'm going to get a lower payment. The break even of the money I brought to closing versus what I save every month on average is about 42 months. There's a lot of people that are going to be refinancing that just bought homes in the last 12 to 24 months that won't see financial gain from having bought down the rate and being sold, that they should have a lower interest rate. So be mindful about this for your family's financial future. Now, as we dive in and go further here, we're going to talk about what is going on right now in Denver. So there, as you heard me talk about what you could do with that savings, with the 1% lower, the 0.5% lower interest rate, what could that do for you over time? But we can't forget what will happen to the value of a home that you own. Here you see a chart from Fred from the St. Louis branch of the Federal Reserve, and you can see home price index for Colorado. Now I've bracketed 1980 to 2020 because right after 2020, we saw a rapid explosion through inflation. And as a result, I've excluded that. But historically, what does that mean? 4.55% appreciation year over year in the Colorado market. So if I bought that $675,000 house and I owned it for, 40 years, I've got 26 years here at 4.55%. Take note that that property sounds crazy. $2.146 million 26 years from now, so long as history just repeats itself. So just what the heck is going on in the Colorado market right now? Well, specifically in Denver, let's talk about, as we kind of wind down here, let's talk about the Denver market conditions. At this time, we're seeing rising number of houses on the market in Denver. As a result, we're seeing numbers back to the beginning of COVID with listings available. Although, as you can see from Altos, the data is supporting that it's still a slight seller's advantage with the market, even with those numbers of homes that y'all feel you're seeing on the market. We have seen home prices flatten out to begin the second half of the year. I'm hearing from my realtor friends that Denver is showing an average of 2 showings a week on listings, and it's taking just under 50 days from listing to contract to sell that house. As you can see here by the graphic I've included, a few other things to take away from that. Rents are coming down a little bit. Inventory has dropped a little bit recently. The reason for that, well, school's back in session, so might people not look to put a sign up in the yard to have their kid come in the house and say, Dad and Mom, why are we selling our house? I just started school. That's probably not happening right now. So keep in mind, there is always seasonality with real estate. As I mentioned in the beginning, really the main focus here is to create education so that as you go to buy a home, you have more knowledge and more power through the education that you can gain. I hope you check out some other videos on the channel. Drop some comments. If you're still sticking around to the end here, drop some comments about what you think relating to the housing market, affordability, mortgage rates. We'll find out very soon.